Hi, everyone. Just before we get going, I want to remind you that everything we talk about and discuss should not be considered as investment advice. The purpose of what we talk about on Catherine Murray Media and Markets on YouTube, as well as Catherine Murray in Conversation With on my podcast, should be viewed as informational and entertainment purposes only. Please definitely do your own research, your own homework, and definitely consult an investment professional before making any investment decisions. And also to note, some of us might hold positions in some of the stocks that we discuss. Colin, great to be able to be with you once again and to get your perspective for our viewers in terms of everything that's been going on in the market. So why don't we just start with that from a top-down perspective? There's a lot of key themes, whether it's inflation, growth versus value, some of these Reddit stocks moving higher. What's kind of top of mind for you?
Top of mind for me lately has just been the large amounts of sector and capital flows that we're seeing between different asset classes and within asset classes. We're continuing to move through this period of economic reopening that has really accelerated in the U.S. and is just starting to get going in Canada this month. But of course, markets that look 6 to 9 months ahead are already starting to anticipate a lot of this. And it's a real shift because a year ago, we went into the lockdown, stay-at-home, work-from-home economy that benefited certain sectors, particularly it benefited technology, communications, and those were stocks that are more heavily weighted in the U.S., particularly on the NASDAQ. And then other sectors like the hospitality, whether that's restaurants or hotels and airlines and things related to personal travel, and then things like energy and commodity prices and financials, because they had to take such large loan loss provisions. And now we're seeing that reverse itself, where even though the technology and communications companies are continuing to do well, there is questions out there among investors of how far can they go, how is their momentum going to do when they face up against tougher year-over-year comparisons, and can they keep it going when the social trends are starting to shift back the other way? Was this a one-time thing, or is this the start of a larger trend? And it remains to be seen on those. And we've seen over the last few months that the NASDAQ has leveled off. The Russell as well, with some of the smaller cap stocks, has started to level off. And meanwhile, indices in sectors that have benefited more from the catch-up and reopening have done really well. Most recently, we're seeing the TSX in Canada has gotten up to 20,000, and that's been driven by the fact that its three largest groups, energy, materials, and financials, have all benefited from this catching up play, from reopening, from the shift from growth to value, and a lot of things like that. And so that's what we're seeing, is this kind of the what we called the K-shaped recovery last year, where some sectors did well and some sectors did poorly, is now kind of reversing itself, almost now into a diamond shape, because we're seeing that divergence that opened up is now starting to close. So initially that benefited the US and the NASDAQ, and now we're seeing the reverse of that, higher relative strength in Canada and in the TSX, and not just Canada, but in other resource-sensitive markets as well. So things like Australia, even the FTSE in the UK has a higher weighting to some of the large cap energy and material stocks overseas. So that index has done well too.
So just to pick up, I mean, there's a lot to pick up on there for sure, but why don't we start with some of the incredible performance that we've seen in the commodity sector on the TSX? And the big question, of course, is whether or not that continues. What do you think?
At this point in time, what I've been seeing is a bit of change in leadership in the commodity sector. So some of the commodities that have had huge moves over the last few months, particularly lumber, are starting to see corrections, and maybe copper a little bit as well. But at the same time, we're seeing other things pick up. Energy has started to pick up again. We're also seeing gold and silver and other precious metals picking up, and even some metals that we don't usually think of, things like lithium, which goes into batteries, things like uranium, which is used, of course, in clean energy, and some of those things have been starting to pick up as well. So it's interesting when we look at commodities, because a lot of times we look at it as a singular asset class, but there's quite a number of different subgroups within it that can perform wildly differently at different points in time.
And so do you still see, like when you take a look then at the various industries or, subsectors of commodities, do you still see a lot of upside? Like if you take WTI as an example, and of course OPEC Plus meeting, what do we take away from that? What's the right thinking in terms of where we'll see the price of oil go next? I mean, I think $77 in 2018 was the peak, most recent peak.
Sure. So at SIA, we do a lot of study into the relative strength and capital rotation and tactical asset allocation. And what we've been seeing lately is that, as I mentioned, that even though some of the commodity related stocks have been coming off a little bit, they've been replaced, and we've seen in our rankings by other stocks moving up. So there's definitely a rotation in leadership through measuring capital flows and price changes between different groups. In terms of energy right now, in particular, looking at the oil price, the OPEC Plus meeting this week was quite encouraging. They didn't add, and they're not planning to add any more production beyond what they had previously announced, and that was about 2 million barrels or so by the end of July, this being the beginning of June. So over the next couple of months. And that at this point in time, the street seems to be thinking that that is an amount that the market can absorb in terms of growing demand. The other one watching for, of course, is the potential. We had seen oil have a bit of a correction in the last few weeks over this reopening of talks with Iran, and could sanctions be lifted to the point where we'd have another big player coming back into the market and adding supply. But as time has gone on, it's become more apparent that this is going to take a while. This isn't going to be something that's going to happen immediately. This could take months. This could take years. Who knows? But it doesn't look like it's going to happen within the next week or two. So the market seems to have cooled their concerns over that. So overall, at this point in time, we're in a situation where the global economy continues to recover and reopen, and that's boosting demand, and the increases and restoration of supply is being carefully managed to keep that in balance, and that has kept sentiment towards energy positive.
And Colin, going back to something you just mentioned, which I think is really interesting and important, that you and your team do work as it relates to capital flows and to be very tactical. Because there's so many different investment styles out there, and I think that's an important one to pay attention to, that not everybody does, but it really does impact the next move up or down for various stocks or sectors. So in terms of where you're really starting to see that flow increase, what are some of the areas? Like you kind of mentioned them, but like what would be one of your top two ideas in terms of where the money's really moving?
So some of the areas where we've particularly seen new capital flows lately, number one has been the banks. They've really been on a roll for a couple of months now. The latest round of earnings reports from Canadian banks were absolutely spectacular. Their banking results didn't seem to be too impacted by lockdowns in Canada, and a lot of them with international operations are benefiting from the recovery in the United States. They're also benefiting from strong capital markets. Strong stock markets have helped to support investment banking and other investment related revenues. So the banking sector is one that's has been particularly strong lately, attracting a lot of interest, a lot of capital. Energy has also been picking up based on the improvement we've seen in the oil price lately. Oil had leveled off for a couple of months, really since about March. And in the last few days, we've started to see it really start to pick up and move higher again. So that has attracted capital back into energy stocks as well.
And Colin, do you see in terms of the move into energy, Canadian energy and Canadian banks, do you see much foreign inflows? Because for so many years now, with the Canadian market the way it's been, we saw an exodus, just even from the corporate perspective, and therefore also, of course, money in the stocks moved out of Canada as well. Has that come back? Are you seeing that?
I haven't seen that in the data that I have. I don't really follow as much data on capital inflows and outflows into Canada, so it would be hard to say on that.
Okay. Fair point. In terms of other areas of the market that are getting a lot of attention, of course, there's so much focus now on the U.S. Federal Reserve and whether or not they're going to start to talk about tapering. So the market's trying to interpret that. And what's your sense in terms of exactly what the market is thinking?
At this point in time, the party line from the Fed has continued to be that they're prepared to let inflation run for a little bit, thinking that if they have a 2% average long-term goal, that's not a ceiling, that's an average. So if you spend a period of time well below 2%, say at 1%, then they might be willing to let it run above 2% for a while to bring that average back up. The other thing they're thinking is that because a lot of the recent inflation has been driven by commodity prices, that as we know, commodity prices go up and down. And the other thing we're seeing is, particularly like over a year ago, commodity prices were extremely depressed in the spring of 2020, and now they've bounced back. So they're significantly higher, but they're asking, well, how much farther can they go from here? And that remains to be seen. So the other part of that, so generally speaking, at this point, the Fed has remained dovish. We had seen U.S. Treasury yields and traded interest rates creeping up back in a couple of months ago, based on the anticipation that, well, maybe the Fed will have to do something at some point. But at this point, it's leveled off in the 160, between say 150 and 175, and it's just kind of sitting there now while people are waiting for something more tangible from the Fed about when they might start running things down. Now, what's interesting is, being June, we do have a number of central bank meetings coming up. So the first one up is the Bank of Canada. And they, of course, have already started winding down their asset purchases. The Bank of Canada had never done anything like QE or asset purchases before 2020. They came in extremely aggressively at that point, and now they're one of the first to start winding that back down again. We also have the European Central Bank. They're still been full on in terms of stimulus. And then later in the month, we have the Fed and the Bank of England and some of the other central banks. So the Fed has their meeting later in June. And so what I think people will be keeping an eye on is a few things. What we call the infamous dot plot, where it's a chart that shows where all the Fed members think interest rates are going to be at the end of this year and next year and so on. We'll see if there's any kind of change or movement there, or if they make any changes to their forecasts, particularly for inflation. The one also thing with inflation that we are keeping an eye on is wage inflation. And we're seeing that through the strong employment reports and job creation. Are we starting to see that push up on wages? Because as I mentioned, commodity-based inflation, price inflation goes up and down, but wages tend to be stickier, and when they go up, particularly the minimum wage, they tend to stay up. So it's not often you see wages getting cut back down. So we are keeping an eye on that. Some companies have had to actually raise wages at the lower end to attract workers in the States, where things are more advanced in terms of reopening. So we're keeping an eye on that.
Yeah. And well, I guess two questions there to follow up on. One is, if the market, is concerned about what the Fed may or may not do, even though that they've been very, very clear that they're not going to cut back on tapering before the economy is in full recovery mode, the market's not going to wait, for the Fed to be very, very clear on that. But right now it seems to be in a bit of a calm that they're believing the Fed today. But what do you say?
At this point in time, it seems to me like that the Fed is probably not wanting to make too many waves through the summer. Historically, when they've wanted to make changes in the direction of monetary policy, they've started to hint towards it at their annual conference in Wyoming in August. It's called the Jackson Hole Conference, and that's often where the Fed chairs have gone to tell the markets that, yeah, we're ready to make changes, we're ready to start raising interest rates or cutting back things, and that goes back to both predecessors, Bernanke as well as Yellen. So it would not be unusual to think that might be where Powell might start to make some hints about what they're planning to do.
Okay. And it's important because it does change. It can have the impact of making the markets very volatile, and also, of course, impacting inflation expectations and interest rate expectations, which of course can put some downward pressure on those tech stocks. So, do you think that there's, should investors who own some of these tech names with the higher valuations, should they be, worried or planning to trim ahead of the Jackson Hole meeting?
Well, at this point in time, we have already seen investors taking some profits as part of the natural rotation of where we've seen some of the previous market leaders had started to level off and come off, and we've seen that in the Nasdaq index as well. So and then we've seen that shifting into some of what we call the catch-up plays, the stocks that had been depressed that are starting to move up. So whether we call that a reopening trade or a shift from growth to value, in a lot of ways that in itself is already underway. Now, the thing we want to consider is seasonality in the markets, and it is oftentimes we've seen historically the markets get off to a fairly strong start to the year up until about May, and then as spring earnings season winds down, say mid-May to the end of June, we often have a consolidation or a correction in the markets, and it's a function primarily of that news flow slows down and people start to go on vacation and things like that, and some of the upward momentum you've had it fades a little bit, or people start to take profits or what have you ahead of the summer. And then you often will see a rebound in an increase in interest again in July around the summer earnings season. And that runs from, say, mid-July to early July to mid-August. And then historically, the weakest and most volatile time of the year for stock markets is between about the middle of August and the middle of October. So, which also right just after the beginning of that is when the Fed has their meetings. So, in terms of the meeting itself, it's of course, something to be thinking about as we get into that part of the summer. But also, that arrives at a point in time when investors are reconsidering their positions, anyways, historically based on seasonality.
Got it. And of course, part of the equation we'll see tomorrow on the jobs front in the United States as well as Canada, in terms of job creation, wage growth, that might also influence, of course, the Fed's meeting this month. But what are your expectations in terms of jobs in Canada and the United States for tomorrow?
Well, the street is expecting US, I believe, around 600,000 jobs, the 550, 600. There's a possibility that it might that you might get a beat based on the fact that ADP payrolls for the private sector, which came out today, were way above expectations. They were almost 1 million jobs created, so it was a pretty spectacular number. And why this is important and why we're looking at employment for the United States is to get an idea of they've had this big reopening run up. Is the momentum continuing, or did we get this surge and then things level off? And so that's what we're watching for there. And that will also help to give us an idea of how much pressure is the Fed actually under. They talk about they're waiting to see for the economy to get fully back up on its feet, and the employment reports can give us an idea of how long is that going to take. Is this something that we might see the economy back up on its feet by the end of this year? Is it going to take into next year? It remains to be seen. And then we look at Canada, where in Canada we're running a few months behind the United States in terms of reopening. I mean, we're just slowly starting to see some provinces starting to come out of lockdown this month, and probably really more next month. So whereas the US, it was a couple of months ago when they 2-3 months ago when they really started to reopen in a big way. Mm-hmm. So based on that, in Canada, we had a loss of 200,000 jobs in April. That was as the economy's locked down. And then now we're looking at May. The street is expecting a loss of around 20,000. So they're thinking it'll be more moderate. I suspect it might be a little bit more than that. But just on the basis that the lockdowns have continued through all of May. And as I mentioned, even so far into the first half of June, a lot of places still remain pretty locked down.
So, yeah, and that's a point in time based on the lockdowns. But if we step back, Colin, what I'm almost hearing from you, though, is you do sound quite bullish on the economy, the reopening, and probably the market, too. Is that accurate?
Yes, overall, I remain optimistic. Overall, equities have continued to attract capital relative to other asset classes. We've seen capital flows into equities and commodities more so than bonds or cash. So investors are still still appear to be bullish and in an optimistic mood at this point in time, and with good reason. I mean, it does look as though we've had a great run on vaccinations and getting a huge amount of people vaccinated in this country in a short amount of time. That we are starting to get up towards those levels where, as they have in the United States, we might be able to start reopening more this summer. And if that's the case, it's certainly beneficial for Canada and for the United States. And as this rolls out in other countries as well, the expectation is that other places may be able to start reopening too. And so we're still really in the early innings of this.
And so from an asset allocation perspective or a geographic perspective even as well, where do you want to put your weightings towards at this point?
So far at this point, what we've seen in terms of relative strength in asset allocation is we have seen Canadian equities have started to outperform U.S. equities in recent weeks, and there's two factors behind that. The first of which is and in the way they're interrelated. One of which is that, as I mentioned, the sectors that Canada is more heavily weighted in and more exposed to have been on a tear lately, and it's been quite some time where we've seen energy, materials, and financials all moving upward at the same time. And so that's been beneficial for Canada. And of course, the other piece of that is that the Canadian dollar has been strengthening relative to the U.S. The U.S. dollar has been generally trending downwards for the better part of a year now, but against all the other major currencies. But Canada has done particularly well, not only against the U.S. dollar, but also against the euro, the pound, the Australian dollar, the yen, and a lot of the other major currencies. And we've benefited from this in a few ways. First off, the Canadian dollar benefits from strengthening commodity prices, particularly energy. But on top of that, as we mentioned, the move by the Bank of Canada to start slowing down on its asset purchases puts them in the more hawkish camp relative to all the other central banks who are either neutral or still full on stimulus. So the only other central bank that's even talked about in terms of, we're thinking about doing it at some point, is the Bank of England. Everybody else is still full on stimulus. So with the Bank of Canada veering off and starting to cut back its asset purchases sooner than everybody else, has put a wind in the sails of the Canadian dollar.
What's the biggest risk out there in your mind?
The biggest risks at this point in time are certainly, we have had an extremely strong run in the markets since the March 2020 low. Things have gone almost straight up for over a year now. So as we head into the summer, we ask ourselves the question of, are markets due for a sizable correction? Or the other option is we could just see things grind sideways for a few months. And at this point in time, it's hard to say, and it may depend on the sector. In some cases, it may depend on the stocks. Something we've seen quite recently is the Reddit stocks have started to explode again over the last few weeks. We saw them soar back in the winter, and some of them held up and some of them ended in tears, and we're starting to see that sort of thing happen again. And so with that kind of volatility, I mean, that's just price-based technical trading that's decoupled from the fundamentals, and so those risks are out there too. It's almost a sense of there's too much money chasing too few stocks, because a lot of things are fully valued, or at least appear to be fully valued at this point in time. And so at the margins, there still seems to be some room for some potential volatility.
Are you surprised that's happening again, those Reddit trades?
I was a little bit surprised that it's started to happen again. I think it's a function of that we did have a bit of a correction consolidation in the markets in the late winter, around March, April, and now we've had to move up, and now we've moved into a phase where earnings season has ended, corporate news flow has dried up. there's not much going on in terms of news to spark this kind of trading interest in the usual big cap tech stocks that a lot of individual traders like to play. The Nasdaq has gone sideways, and with that, I think we've seen people starting to try and going back to chasing things out at the margins once again.
It's pretty amazing, because we do know that a lot of people got very hurt by doing that, but they're back at it.
Yeah, it's quite amazing, the resilience there, and
Yeah.
And it just shows there's still a lot of money sloshing around out there right now.
So I guess, Colin, bottom line, then for our viewers, their takeaway at this point, when they think about their investments, their holdings, their portfolio, what should their mindset be?
At this point in time, we equities have been continuing to attract capital and continuing to attract interest from investors. But it's important to remember that over the last year, equity markets have, it's really been more a story of sectors and individual companies, and that has not changed. It's the players and the leadership has been shifting, but because of the nature of this recovery and the impact of lockdowns and reopenings over the last year, that's the whole thing still has not completely played out. And so because of that, even when in times when we might see indices doing different things, it's really the sector action that's been the most important. That's where we're seeing the biggest changes in tactical moves, in tactical allocation, and in capital flows.
And the best upside and the most opportunity. So to get the sector rotation right.
Absolutely, absolutely, and that's where we've been seeing that investors have been able to particularly benefit and to take advantage of the divergences between different groups over the last year. This could continue for some time yet.
Okay. All right, Colin, we will leave it there. It's great to see you and be with you and have a longer format for our conversation. So thank you.
Likewise, this was great.
Good. Thanks so much, Colin.